Overtrading feels productive, and that's exactly why it destroys consistency. Here's the hard truth. Action isn't progress. It is a statement that often gets overlooked because the activity itself feels like genuine work. Constant clicking decision-making. It mimics the sensation of being engaged and proactive, of steering one's own financial destiny. Yet, this very feeling of productivity is a dangerous illusion. It masks a deep-seated behavioral pattern that slowly erodes a trader's edge, their capital, their mental well-being. The market does not reward effort. It rewards correct decisions made at the right time. Often, the right decision is to do nothing at all. This is the paradox many developing traders struggle to accept, and this is where most traders don't realize what's happening. This is the part most traders don't notice. They misdiagnose the problem entirely. They believe their struggles stem from a flawed strategy, a missing indicator. Why does it feel right? The answer lies in two psychological drivers: the illusion of control, the chemical reward, dopamine. Every time a trader clicks the buy or sell button, they perform a decisive action. It creates a powerful, albeit false, sense of being in control. Taking a trade feels like grabbing the steering wheel, like making something happen, imposing your will on the market. It's deeply satisfying even if the outcome is random. Anticipation and execution trigger dopamine release. Gambling, video games, checking social media notifications. Each trade can give a small hit of dopamine. That creates a feedback loop. The trader feels restless. They take a trade. They get a dopamine reward. They feel temporary relief. That reinforces the impulse to trade again. Focus shifts from executing a high-probability plan to satisfying an internal craving. Consider a realistic retail trader scenario. Let's call her Jane. Jane has a plan focused on a reversal pattern on a 15-minute chart. Her rules: risk no more than 1% of her account. Her rules: take a maximum of 2 trades per day. On Monday morning, she waits 2 hours. The setup never appears. She feels restless and anxious. Classic FOMO. She drops to a 1-minute chart, a time frame her plan forbids, and sees a small breakout. She tells herself it's just a small scalp to stay engaged. She takes the trade, a tiny win. She feels relief. That small win reinforces the bad behavior. Now Jane is hunting for more setups on the lower time frame. She takes 2 more quick trades. First, a small loss. Second, a break-even. The damage from overtrading extends far beyond the direct financial losses recorded in the trading ledger. The most significant costs are often hidden, depleting the trader's 2 most critical resources: emotional capital, cognitive function. Overtrading creates immense emotional fatigue. Each trade, even a small one, requires mental energy for analysis, execution, management. When a trader takes 10 trades in a day, 15 trades in a day, 20 trades in a day instead of their planned 2, 3, they are subjecting themselves to unsustainable stress. This constant engagement leads to mental exhaustion, which is the enemy of discipline. A fatigued trader is a compromised trader. When you are mentally tired, your willpower weakens, making it exponentially harder to follow your rules. This is when traders widen a stop loss, chase price that has already moved, or jump in without full confirmation. These are not strategic mistakes. They are symptoms of decision fatigue. The quality of each subsequent decision degrades, and the likelihood of a major error rises with every unplanned trade. And this is where accounts quietly start bleeding. Overtrading negatively impacts how a trader perceives the market. They begin to project their desire for action, seeing patterns that are not there, confirmation bias. Entries become sloppy, exits become hesitant. Slippage increases. They blame the market or broker, failing to see their own degraded mental state. The ultimate cost: when a true setup appears, the overtrader is too drained, diminished, or distracted to execute it properly. Professionals understand that willpower is finite. They don't rely on sheer fortitude. They operate within rigid rules that short-circuit impulses. They build guardrails that force them to stop, reset, preserve their capital. These rules are simple, but their power is in strict, non-negotiable application. Here are 5 concrete actions. 1. Trade fewer setups. Professionals master 1 to 3 high-probability patterns and wait for exact criteria. If an A-grade setup isn't present, they do not trade. No exceptions. 2. Set a maximum number of trades per day or week. A hard cap. For example, maximum 3 trades a day. Winner, loser, or break even. After the third, the day is over. This acts as a circuit breaker against revenge or euphoria trading and forces selectivity. 3. Use a smaller fixed position size to lower emotional stakes. Less money per trade reduces the need to be right and makes following the plan easier. 4. Implement a cool-down rule. Example: after any loss, step away for 1 hour. After 2 consecutive losses, done for the day. This break cools emotions and allows a reset. 5. Maintain an execution-focused journal. The why behind each trade. Note emotional state, entry reason, whether it adhered to plan. Review regularly and grade process over outcome. Notice how none of this involves a new strategy. Overtrading feels productive because action feels like progress, but the chemical reward hides slow damage, fatigue, broken rules, poorer decisions. The fix: fewer trades, hard caps, smaller size, cooldowns, and an execution journal. Take a breath. Progress is built quietly, over time. None of this is advice, it's perspective. Risk is real, your capital is always at risk. If you feel stuck, look at behavior before strategy. Quiet the urge to act. Let patience become your edge. Most traders don't fail because of strategy. They fail because they don't stay long enough to let discipline work.